What's up, Investomaniacs? Your boy Knight Rider here, and today we're going to be talking about enterprise value. Enterprise value is a more comprehensive alternative to market capitalization, which is the total amount of money that you have to pay for a company. So, enterprise value equals market cap, how much you have to pay for the company, plus the debt, because you absorb the debt when you buy a company, minus the cash and cash equivalents, because you also get the cash and cash equivalents when you buy the company. So that would lower the cost of the acquisition, right? Whereas debt would increase the cost of acquisition. Now, the cash and cash equivalents may or may not include marketable securities and non-marketable securities. Often current marketable securities, that's less than 1 year, are included, and non-current marketable securities, those are things that are you can't get for more than 1 year, may or may not be included. I personally like to include non-current marketable securities. So what's the difference between marketable securities and non-marketable securities? Marketable securities are things that have can be easily bought and sold. They have the public market for it. So there are, for example, public companies. If you buy a share of Apple, that would be a marketable security. It's something you can just sell tomorrow with no issues. Non-marketable securities would be, say, shares of a private company. So if you buy shares in a private company, it's a lot more difficult and cumbersome to buy and sell those shares. That would be a non-marketable security. Similarly, there are forms of debt which have a public market for it and can be easily bought and sold, and there are forms of debt which do not have a public market and are a lot more difficult to buy and sell. That would be a non-marketable security. And then again, remember, current is less than 1 year, non-current is more than 1 year. All right, so let's take a look at some extreme hypothetical examples to get the point across. Company XYZ has a market capitalization of $1 million, but it also has $2 million in cash and $0 in debt. So its enterprise value is $1 million market cap plus $0 in debt minus $2 million in cash, giving you an enterprise value of negative $1 million, meaning all other things being equal, you could hypothetically buy the company for $1 million, cease production, liquidate assets, and make a $1 million profit just by taking that $2 million in cash, right? $2 million in cash minus what you had to pay for the company, $1 million, and you make a profit. There are not, like, obviously this kind of extreme and easy to understand, but there are examples of companies where people will go into very low trading companies that aren't popular, and they'll buy it, they'll just cease production, liquidate all the assets, pay off the liabilities, and take the cash, and they will make a profit by shutting down the company because it's trading so cheaply. Conversely, company ABC has a market cap of $1 million. This time it has $0 in cash, $2 million in debt. So your enterprise value is $1 million market cap plus $2 million in debt minus $0 in cash. So this time you have an enterprise value of $3 million. So it's actually not $1 million to kind of buy the company. It's really more like $3 million because you have to pay $1 million for the company, but then you're also taking on $2 million in debt. Let's take a look at a real life example that everybody can kind of understand. Let's take a look at Apple, which has a market cap of $943 billion. So let's go ahead and take a look at their assets. We have current assets, less than 1 year, cash and cash equivalents, these are in millions, 50 billion, 533 million, marketable securities, 44 billion, 84 million. And then we have our non-current assets, marketable securities, 115 billion, 996 million. All right, and now we go to our debt, and we have our commercial paper. Commercial paper is a form of debt. It's kind of like a note that a company will issue to raise capital. So just think of it as a form of debt, and that is about $10 billion. And then we have our current debt, so that's our short-term debt of $13.5 billion. And then we have our non-current liabilities, so we have our long-term debt, which is $84.9 billion. Okay, so let's go ahead, and I have the numbers I just told you right here: cash equivalents, marketable securities, blah, blah, blah. There are no non-marketable investments for Apple, but I just gave you a little example here. This is Google here, Alphabet. This is Google, and under their assets, they have non-marketable investments. So typically, marketable investments either aren't going to be there, a lot of companies don't have them, or they're not going to represent a large chunk of the pie. But if you do find something where it has a large chunk of non-marketable investments, relative to the size of the overall company, then you do want to do some looking into that and find out if you can. It's not always available, but you want to see if you can find out what type of a non-marketable investment is. Like, is it a form of debt that can't be bought and sold easily, because that's more likely, like I would include that, as opposed to if it's shares of a private company. That's something which I would probably either discount the value of, because it's a lot less secure that you'll actually ever get that money back, because obviously companies go out of business all the time, and it's more likely that private companies are going to go out of business. Or I might not include it at all if I don't like the investments. But you may not be able to get that information, in which case you kind of just have to make your own decision on how do you want to include it, not include it, or do you want to include it at a discount. There's not really a right or wrong way to do that. Sometimes I'll just run both numbers. And then we have our debt. Again, this is back for Apple, our commercial paper, short-term, long-term debt. So our assets come out to $210.6 billion, and our debt comes out to $108.4 billion. So our enterprise value for Apple is $943 million market cap, plus the $108 billion in debt, minus $211 billion in cash, giving us an enterprise value of $840 billion. So $840 billion actually represents a 10.9% discount to $943 billion. So however much you thought it was going to be to buy the company based upon its market cap, it's actually 10.9% cheaper. Similarly, if you flip that around, if you were to start out with the enterprise value and then go up to market cap, it would be a 12.9% premium. So it's quite a bit, it is a decent little chunk there, more expensive and cheaper to, take into consideration that enterprise value relative to just the market cap. So anyways, I hope you guys enjoyed. Please subscribe if you're not subscribed. Have a great day, Investomaniacs.